Hi guys, my name is Vlad. I'm a real estate agent with the Purple Tree Real Estate Group. Today we'll be covering what's going to happen in just the next few weeks, and that is the rate announcement by the Bank of Canada coming in September, on September 6th. We right now in the middle of August, and there's a lot of speculation, a lot of anticipation, anxiety with the investor community specifically, but also with buyers and sellers in the marketplace when it comes to real estate, when they are considering that there's going to be potentially an interest rate hike. So there are three ways in which the rates can go in September. They can go down. I don't think this is going to be the case. They can stay flat, or they can put a pause on this, or they can go up. So I would only consider as the probable cases the potential for the increased interest rates or a pause in the interest rate hikes. So let's just first get on the same page and look at the mandate for the Bank of Canada, because this will help us explain the decisions that the decision whether they're going to be making that they're faced to make. So the mandate of the bank is to promote the economic and financial welfare of Canada. And then the bank has four core functions. The first one is the monetary policy one. So the bank's monetary policy framework aims to keep inflation low, stable, and predictable. In fact, they've made a number of announcements that they're planning to bring the inflation down. That's the target, to 2%. 2%. Now, that's the first thing I wanted to make sure that we're on the same page on. And the second thing is the 12-month CPI read, Consumer Price Index read, on the inflation. So right now, as you see, we are showing the July numbers, which came out just about a week ago, back in August, or rather a few days ago in August of this year. We're in August 17th right now. And we're at 3.3%. So we have experienced a jump from June. We were at 2.8%. The CPI had jumped largely due to the base factors, how the inflation is calculated as the numbers fall off from the 12-month prior data. We see that the inflation is increasing. It was actually widely anticipated that the inflation is going to go up to 3.2 to 3.3%. And it's very, very probable that by the end of the year, we're going to hit a number above 4% on the inflation numbers. On this chart, there are two lines. As you see, one is in dark navy. That's the CPI, Consumer Price Index. And the other one, which is in light blue, the same thing, but excluding the energy. So things like natural gas, oil, and things like that. So right now we're at 3.3%, which is pretty similar to where we were back in June or July of 2021. And a lot of people looking at this chart may assume that this is actually tracking the numbers, or rather the prices going up and down for the items in the Consumer Price Index basket. But in reality, it's not. It's not showing the prices, it's showing the acceleration of those prices. So in other words, if you see that the lines on the chart go up, that means that the prices are accelerating higher. But if the line on the chart stays flat or even goes down to zero, that barely means that the prices are flat and they're not increasing for that particular period of time. That's all. All right, so now that we're on the same page, let's look at some of the factors that the Bank of Canada is going to be considering when they're looking at making the decision. The first one, not necessarily the first one on their list, it's the first one on my list, is the labor force. So they're going to be looking at the labor situation. And in the month of June, we've created 0.3% of new jobs in the economy, which roughly equals to 60,000 new jobs created. Following that, in the month of July, we lost about 6.5 thousand jobs. All right, so when jobs are created, that's bad for inflation. That's a reason for concern for the Bank of Canada and could potentially lead to an interest rate hike. When jobs are deleted or shed, as was the case in July, that's kind of good for inflation, meaning the inflation will likely subside and the Bank of Canada does not need to be as aggressive. But at the same time, there's another factor with this is that the hourly wages have increased by 5.5% in July, and that kind of counterbalances all the positive considerations from the Bank of Canada standpoint. And based on this data point alone, it seems that the probability of them pausing the interest rate increases or actually hiking the rates is about 50-50. So let's move on to the next point. The next one is gasoline prices. And I also want to take you to a page that shows us what's happening with gasoline prices. And even though this is a Canadian site, but somehow they're tracking gasoline prices in Canada in the US dollar. So a year ago, and this is a 12-month chart, we were at $1.26. Then just about a month ago, we were at $1.26 US again in Canada. And you probably saw that when you were filling up your cars if you're not driving electric. And then right now, in the month of July, just about a month ago, we are at $1.12, which, if you translate it into Canadian dollars, pushes us just above $1.50 Canadian for a liter of gas. The gas prices are trending up as well, and they will likely be increasing between now and the end of the year. At the same time, this is a lagging indicator, and it has a latency period of anywhere from 3 to 6 months. So we will not see it impacting the CPI numbers or the inflation numbers most likely until the end of 2023. But then we will see the impact of prices, which have a tendency to trickle down to all of the sectors of the economy over that 3 to 6 month period of time. And then we will see the inflation rise because of that in the first and second quarters in 2023. So that's one of the most likely things to happen with that. Now, on this point, it seems that the Bank of Canada should be aggressive, and I would assign the probability of over 50% of them raising the interest rates just because of the gas considerations. Next one is just an interesting one. Mortgage interest costs actually rolled into the CPI calculations as well. And it's a catch-22 for the Bank of Canada as they're trying to battle the inflation. They raise interest rates, and then they look at the gauge, and the main gauge that they have is the CPI numbers, but the gauge is skewed because you raise interest rates, mortgage rates go up, and then people pay more money in interest that goes back into the economy, which is a bad thing, and then the inflation goes up. So I'm not entirely sure how they are going to address this quandary. Maybe just removing the mortgage interest rate costs from the CPI calculations, although in reality, that's not going to do anything. It's just going to be a cheap trick to improve the numbers. Now, the newly released CPI numbers at 3.3%, we mentioned that in passing in the beginning, or I did. I'm not going to start referring to myself in the third person. In June, they were at 2.8%. And as I said, this is largely due to the base effects or how the numbers were showing just a year ago. There are alternative points of view as to why the Bank of Canada or what the Bank of Canada is thinking. And one of those alternative thinkers is the Deputy Chief Economist of CIBC, Benjamin Tal. And I wanted to allow you to listen to what he has to say for a few seconds. Well, the clip itself will probably take about a minute for you to listen to. So there we go.
Tell us where you think the bank is going.
Yes, because quite frankly, this bank is not neutral. It's biased, and rightly so. We have to realize one thing. You give the Bank of Canada two options. One is a recession. The other is inflation, and inflation expectations rising. They will take a recession any day because they know that if they overshoot, they can fix it by cutting interest rates. If they undershoot, then inflation expectations go up. You don't know what to do with it. So clearly they are biased, and they say, you know what, if we are going to make a mistake, let's overshoot as opposed to undershoot. Therefore, given this environment, theoretically speaking, for every good...
Got that? So he's essentially saying that the Bank of Canada is biased. And actually he goes on to say that had we had an AI governing the monetary policy instead of the bank, which is populated with humans with their own insecurities, concerns, incorrect predictions and biases, interest rates would have probably stayed at 3 to 3.5%, meaning that we would have not had the increases that we had over the course of the preceding year. So at the same time, he explains the bias. In Benjamin Tal's view, if the Bank of Canada overshoots and raises interest rates more than they should, and then that will result in the economy dipping or diving into recession, they have a toolbox to fix that. They at least, at the very least, have two ways of extricating themselves from that situation. Number one, they can always continue with the money printing bonanza that we had since the beginning of COVID, and then pumping that money back into the economy, something that's called quantitative easing. Or as an alternative to that, they can lower interest rates, and those measures, especially combined, will most likely extricate the economy out of the recession very quickly. On the other hand, if they don't address the interest rate issue right now, they will likely have to raise interest rates even higher at some point in the future because of the consumer sentiment. If they, by their messaging, will encourage the consumers to go and spend right now, pumping more money into the economy, the inflation will have a tendency to spiral out of control, and they will have to raise interest rates to a higher point than they would have had they addressed the issue of inflation right now. So they're biased, they're careful, but there's a reason for that. At the same time, the Bank of Canada is giving us a clear indication, and this is a psychological part of the message. The first part was purely mechanical. We have the toolbox, we have the tools to actually fix things if we overshoot, and it's much worse for us if we undershoot with the interest rate hikes. But the psychological one is they make an announcements that the inflation is going to continue staying high up until sometime in 2025. Therefore, they're sending a message to the consumers that the road ahead is tough and you better tighten up your belts and not go out and spend extravagantly, pumping more money into the economy and causing for the inflation to continue rising. So that's a psychological statement that they make, and this has a similar impact to them actually raising interest rates physically at the bank level. Now, the other thing that's worth mentioning is that the Bank of Canada is also keeping track of inquiries coming into the banks for mortgages. So they're seeing that inquiries for fixed-term mortgages, under 5 years, have intensified. So there's a lot more inquiries about that, which sends a clear indication to the bank that the consumers are believing that the interest rate hikes have peaked. And they want to send a strong signal to the consumers, to the Canadians in general, that this is not so. We are going to have some difficulties ahead. The inflation is going to continue rising, and the first interest rate decline that will possibly happen is going to happen somewhere between 2024 and 2025. So we're talking about a couple of years out. And the last thing I want to mention is that right after the last interest rate hike, the real estate market had reinflated almost instantaneously. Within the 2 weeks after the announcement, we were back to prices that we had 2 weeks before the announcement, before the public started panicking. So that panic didn't last long. And definitely the Bank of Canada is not interested in continuing the appreciation of the housing market at the same breakneck pace that we had earlier in the year. So with all of those considerations, with everything that we've discussed in this video, with all the data points, and by no means this is an exhaustive analysis, but with all the data points that we have addressed, in my estimation, the Bank of Canada is more likely to increase interest rates in September rather than to keep them where they are right now. And certainly I see no reason whatsoever for them to be bringing the interest rates below the current price point. So with all of that said, if you're not sure about what to do, about how to position your property price-wise, or in terms of the timing of the marketplace, give us a call, schedule a calendar appointment with us. The link is going to be in the description below. It's a very simple process. You can see our availability, and when I'm talking about our availability, it's between myself and my partner, Mitra. You can schedule a conversation with one of us, and we'll be happy to share all the knowledge and information that we have about the market, about what's happening in the marketplace. And not only are we going to talk about the publicly available information, and this was the bulk of this conversation, of this video right now, but we also can share with you the information that we're getting from the field, because we're active agents. We actively work with buyers and sellers, and we see what's happening in the marketplace from within. So we're going to share that information with you, help you out with positioning your property, and helping you either sell it or helping you on the buy if you're interested to get into the investment, you increasing the size of the house, maybe you are retiring, whatever your case is, we're there to help, and we're there to give you the knowledge that we have. That's about it. Give it a thumbs up if you like the content. Consider subscribing so you don't miss any of the new videos that are coming out every single week. And I'm looking forward to seeing you again in about a week's time.